Can directors and shareholders of a company draw money out of a business? Hi, it's James Ginty from Elements Advisory Group. We are asked this question quite frequently by business owners. Can I draw money out of my business? The answer is yes, you can. But it's not as simple as drawing money out of the business bank account for your own personal use. The ATO might treat this as a separate income and you could be taxed twice. The company, as a separate legal entity, will be taxed on that profit initially, and you'll be taxed again on that same profit in your personal income tax return. As a director or shareholder, if you want to benefit from your company's profits, do it the right way. There are 3 ways that you can draw money out of your business for personal use. The first and most obvious one is the director salary, wages, or director fee option. This one is pretty simple, as it's essentially putting yourself on payroll, paying yourself a salary as an employee of the company with all the relevant PAYG and super obligations considered. Every business is different, so the salary that a director pays themselves will differ depending on the nature of the business and its cash flows. When considering what amount to pay yourself, a director should always consider individual marginal income tax rates. For example, at $125,000, the marginal income tax rate for an individual surpasses the corporate tax rate of 25%. Therefore, every dollar a director pays themselves above $125,000 will be taxed higher in their income tax return when compared to leaving those profits in the company. Above this $125,000 threshold, a combination of salary and dividends may be a more tax-effective strategy for the director. Ultimately, however, it's up to you as the director to decide how much you pay yourself as a salary. Whether you're paying yourself a low salary or a benchmark salary of $125,000, you could use the dividend payment option to access retained earnings from the company as a top-up to your personal income. Whatever profit the company has made, we can pay that out as a dividend to the company shareholders twice a year, the interim dividend and the final dividend. Should you choose to go down this path of dividend payments, you need to have enough retained earnings within the company, and the company must remain in a positive net asset position after the dividend has been paid. If the company has already paid tax on profits prior to paying out the dividend to shareholders, franking credits will be available. These are credits for income tax that has already been paid by the company, which are subsequently passed on to the shareholder when the dividend is paid. These credits reduce the amount of tax you pay on the dividend income when it's included in your personal income tax return. The third option for directors and shareholders to draw money out of the company is through a director loan. These arrangements are heavily regulated by the ATO under the provisions of Division 7A. However, where certain conditions are met, shareholders may be able to borrow money from the company and pay the company back over a 7-year period. With a complying loan agreement in place, which dictates the minimum annual repayments of principal and interest over the loan term, the loaned money from the company is not treated as taxable income to the shareholders. This can be an attractive option for company shareholders looking to access company profits without triggering immediate income tax consequences for themselves personally. Where directors and shareholders access company funds without complying with Division 7A provisions, the whole loan may be treated as an unfranked dividend from the company and taxed in the hands of the shareholder in the year in which the funds were provided. This can have severe tax consequences for both the company and the shareholder. These are the 3 different options that directors and shareholders can use to draw money out of their company for personal use: director salary or wages, dividend payments, and the director loan option. You may wish to consider using a combination of these 3 to reduce your income tax liabilities. Each option has benefits and drawbacks, so it's important to understand how each option works, if it's right for your company, your tax structure, and your personal circumstances. You should always consult your accountant first to ensure you fully understand the tax consequences of each strategy before drawing money out of your company. Of course, feel free to reach out to our specialist tax team to discuss your remuneration strategy, what suits your financial circumstances and tax position. Email us today at admin@elementsag.com.au or call us on 07 3878 9181.